Okay, so have you ever gone all in on a stock? Like you hear this tip or whatever and you're feeling like this is it, I'm going to be rich.
Uh-huh. Yeah, I think we've all had that moment.
Right, and then you wake up the next morning, check your phone and crash. Your investment is like toast.
It's the worst feeling. The market can turn on a dime, that's for sure.
Totally. But what if there was a way, some kind of safety net, to make sure that even on those worst case coffee spilling mornings, you don't lose absolutely everything?
Well, that's what we're diving into today, negative balance protection.
Exactly. And we're specifically looking at Monaxa, this trading platform that's making a big deal about this feature.
Yeah, they're really pushing this whole safety net analogy.
So let's unpack it. What is negative balance protection?
In the simplest terms, it's a promise that you won't lose more money than you actually put into your trading account.
Okay, so like a financial guardrail.
Exactly. You hit the guardrail, you might get a little banged up, but you're not going to go flying off the cliff.
Right, that makes sense. So how does this work in practice?
Well, Monaxa talks about real-time monitoring of your account. It's like having a hawk watching your trades constantly.
Intense. Okay, so then what? Like, if it looks like you're about to lose everything, the hawk swoops in and saves the day.
Basically. It's all automated, of course. They use what's called a stop out. If your account balance gets too close to zero, the system automatically closes your positions.
So even if the market's moving super fast, like faster than anyone could react, this stop out should kick in and prevent you from going negative.
That's the idea, yeah. It's designed to be incredibly fast.
But what if, and maybe this is far-fetched, but still, what if the market moves so insanely fast that your account goes negative before the stop out can even happen?
Yes, that's where Monaxa's big promise comes in. They claim that in that extremely unlikely scenario, they will actually reset your account to zero.
Wait, so they're saying they'll eat that loss? Just like that? What's the catch?
Well, that's the million-dollar question, right?
Mm.
Monaxa does seem to be pretty transparent about it. It's there in their terms and conditions.
Okay, so it's not some hidden fee or anything like that.
Not that we could find, but you are right to be cautious. Anytime a company is offering something that sounds too good to be true, it's worth taking a closer look.
Absolutely. Now, Monaxa does highlight a few specific situations where this negative balance protection is supposed to be especially useful.
Right, like high leverage trading.
Which to me always sounds a little bit terrifying, like financial tightrope walking with no safety net.
Uh-huh. Yeah, it can be risky. Basically, leverage is when you borrow money to amplify your potential gains. But of course, that also amplifies your potential losses.
So if you're leveraging a volatile stock and the price suddenly tanks, negative balance protection could be the difference between a manageable loss and, complete financial ruin.
Exactly. It's a huge safety net in those situations.
And it's not just about high leverage, right? Monaxa also mentioned overnight positions as a potential risk.
Yeah, because anything can happen when the markets are closed. You go to sleep, everything seems fine, and then you wake up to utter chaos.
Ugh, don't even get me started on overnight positions.
Yeah.
Remember that whole meme stock frenzy a while back?
Yeah. Oh, absolutely. That was wild. Talk about unpredictable markets.
Exactly. So this negative balance protection, it's almost like having insurance against that kind of overnight market madness.
That's a good way to put it, yeah.
Now, there was one more thing that Monaxa mentioned. Low liquidity. What does that even mean, and why is it a problem?
So imagine you're trying to sell something, but nobody wants to buy it. You're stuck.
Like trying to sell a house in the middle of nowhere.
Exactly. That's low liquidity in the trading world. When there aren't enough buyers or sellers for a particular asset, it becomes much harder to get in or out of a trade quickly.
And if you're trying to get out of a losing trade but there's no liquidity, you're kind of stuck.
Exactly. Negative balance protection could be a lifesaver in those situations.
Okay, so if I'm understanding this right, negative balance protection is like having an escape hatch if the market throws you a curveball, whether it's high leverage, an overnight surprise, or just low liquidity.
You got it. It's a way to manage risk, which is crucial in any investment strategy.
Absolutely. But, and this is important, it's not a license to be reckless.
Right. It's not about eliminating risk altogether, because that's impossible.
It's more about having a safety net in case things go wrong.
Exactly.
So before we wrap up, any final thoughts on negative balance protection? Should every trader be demanding this?
It's definitely a good thing to have, especially for newer or less experienced traders. But remember, no safety net is perfect. Always do your own research, understand the risks involved, and never invest more than you can afford to lose.
Kind of said it better myself. Always do your homework. Well, that's about all the time we have for today's deep dive, but here's a final thought to ponder. Does having this negative balance protection, this sense of security, actually make people more likely to take bigger risks? It's something to think about. Until next time, happy trading.